For the last 20 years, software investing has been built on one single, incredibly powerful idea. Well, I'm here to tell you that idea is now obsolete. We are staring down a structural dislocation bigger than the shift to the cloud, and it's creating what I call a kill line that is going to slice right through the entire sector. So let's just cut to the chase and ask the most important question right now. Is your portfolio, the one you've carefully built on the rules of the last 2 decades, is it already obsolete? Because this isn't some far-off risk. The deflationary force of AI is here right now. Okay, so what is this AI kill line? It's the exact point, the threshold, where software stops being a helpful tool for a human and it becomes the human. It becomes the worker. And let's be crystal clear, this is not a new feature set. This is a fundamental, seismic break in the economic engine that has powered software for a generation. To really get why this is so massive, you have to understand the old fortress, the per-seat pricing model. For years, it was beautiful. A vendor's revenue was perfectly tied to a customer's headcount. They hire more people, you sell more seats. Predictable, compounding growth. Well, that fortress is now crumbling to the ground. Now, this slide is absolutely critical because it shows a complete inversion of the business model. Just look at the key metrics here. The unit of value, it's no longer a user login. It's an outcome, the actual work being done. The growth driver, it's not about how many people a customer hires anymore. It's about how much more efficient you can make them. And here's the killer: marginal cost. It used to be basically zero for old software. Now, with AI, every single action has a real, tangible cost because of compute power. Yeah, for 20 years, this was the magic number: 80–90% gross margins. It was incredible. Once you wrote the code, adding another user cost you absolutely nothing, and the market rewarded these software-grade margins with massive valuations. And welcome to the new reality. Every time an AI agent performs a task, it costs real money in compute. This is what we call the inference tax. And what it means is that the gross margin profile of the entire software industry is being permanently reset downwards. So the bottom line is this: the only way to survive is to completely pivot your thinking. You can't make money by charging for the human using the tool anymore. You have to figure out how to charge for the work the robot is doing. That is the new economic imperative. Full stop. All right, so let's get on the battlefield and see how this plays out. We can actually use this framework to categorize the entire public SaaS universe based on how close they are to the kill line and whether they can adapt. This is how you need to think about navigating your own portfolio right now. First up, you've got your legacy players who are at extremely high risk. Workday is the poster child for this. Their entire business model is structurally welded to their customers' employee count. They literally charge based on the number of workers in the system. That puts them directly in the crosshairs of this whole thing. And this quote just nails the danger. Think about it. If AI makes HR departments way more efficient, hiring slows down, maybe departments even shrink. What happens then? Workday's entire growth model just breaks. So when you see a super tech-forward company like Klarna publicly say they're dropping Workday to build their own internal AI tools, that's not just a signal, that's a 5-alarm fire. Next, you've got the transitional companies, and Salesforce is the perfect example here. They defined the seat-based model, and now they're trying to pull off this incredibly dangerous pivot. They see the kill line coming, they're trying to get across it, but honestly, the outcome is highly, highly uncertain. And this is the core of their huge gamble with their new AI agents. To survive, they literally have to cannibalize their own high-margin Service Cloud seats. They have to hope that they can replace that fat revenue stream with tons of tiny, low-margin AI transactions. They have to destroy their old business to build a new one, which, as you know, is one of the hardest things to do in business. Okay, now let's talk about the early survivors. A company like Palantir is interesting because they were just built differently from the very beginning. You could argue they've effectively already crossed the kill line because their entire focus has always been on delivering outcomes, not on selling seats. And here's the proof. The ridiculously high revenue per employee shows you the incredible leverage they have. They're not making money off of human activity, they're monetizing the entire enterprise operating system itself. Their secret sauce is their focus on data ontology, which is just a fancy way of saying they build a map of how all of a company's data is connected. And because they understand those deep relationships, their AI can do complex work that these simple AI wrappers just can't touch. So you might be asking, if this is all so obvious, why isn't the risk priced in everywhere? Well, it's because the market is still looking in the rearview mirror. It's relying on outdated metrics, and it is completely failing to see the structural shift. This is creating a massive value trap for the unwary. but it's a huge opportunity if you understand the new physics of this world. Investors absolutely love high net revenue retention, but right now it's a trap. A company can show you beautiful NRR today by upselling some fancy AI copilots to its existing customers. But what happens if those same copilots lead to a 20% headcount reduction next year? The core revenue base of seats just collapses from underneath them. And this chart really shows the problem. That impressive NRR figure, that growth you see, it's all built on a foundation that's about to turn into quicksand. The market is modeling this nice linear seat growth, but it's not ready for a sudden contraction. We're heading for what I'd call an air pocket, where the AI upsell just can't hide the seat downsell anymore. There's also this huge confusion between adding AI features and having an AI business model. Look, anybody can add an AI chatbot. That's just a feature. But if you don't fundamentally change your pricing to capture the value that feature creates, you're just engaging in what's called deflationary innovation. You're spending a ton on R&D just to destroy your own future revenue. And finally, as an investor, you have to completely abandon your expectation of 85% gross margins. It's over. As these software companies basically become compute resellers, their margin profile is going to look a lot more like a utility. And you can bet the market will punish that margin compression unless it's offset by absolutely massive volume. The margin mirage is over. So let's bring this all home to a final verdict. If you want to generate alpha in this new world, you have to ignore the lagging indicators everyone else is looking at. And you have to focus on the forward signals, the little clues that tell you if a company is really crossing the kill line or if they're just pretending. This is your practical toolkit. This is what you need to be listening for on earnings calls. Are they talking about outcomes and consumption, or are they still talking about seat expansion? Is their revenue per employee going up faster than their headcount? Is the revenue mix actually shifting? These are the questions that matter now. So the investment thesis is simple and unambiguous. The easy money you made just by buying a basket of cloud stocks, that's gone. To survive, companies must be willing to cannibalize their own cash cows. The winners are going to be the ones who figure out how to tax the robot, not the human. And at the end of the day, the only durable moat left is proprietary data gravity that makes your AI impossible to replace. And that leaves us with one final, urgent question. I want you to take a hard, honest look at your portfolio and ask yourself, which side of the kill line are my investments on? Because the Great Reset, it's already happening.